On a single day in October 1987, the American stock market fell by 22.5%. Not over a month, not over a week, in one day. It remains, to this moment, the largest single-day collapse in the history of the market, nearly double the worst day of the Great Crash of 1929. But here's what makes Black Monday different from every crisis before it, and genuinely frightening in a new way. In 1929, humans panicked. In 1987, the humans barely had time to, because this crash was driven and accelerated by machines, computer programs, executing on their own, selling into a falling market faster than any person could think. It was the day Wall Street discovered that it had built something it no longer fully controlled. The first crash of the machine age. And to understand how the market got there, we have to go back. Not a few months, but almost 20 years, because the seeds of 1987 were planted in one of the strangest, most turbulent decades in economic history. Our story begins on a Sunday night in August 1971, when President Richard Nixon went on television and, with a few sentences, quietly rewrote the rules of money for the entire world. For decades, the dollar had been anchored to gold. The system was simple. The dollar was fixed at $35 per ounce of gold, and foreign governments could take their US dollars and exchange them for real gold from America's vaults. The dollar wasn't just paper, it was a claim on something solid. But there was a problem. America had printed far too many dollars to pay for war and ambitious spending, and now the world had more dollars than America had gold to back them. Foreign nations, France especially, had begun cashing in their dollars for gold and shipping it home, draining America's reserves at an alarming rate. So Nixon simply closed the window. He ended the dollar's link to gold. From that night on, the dollar was backed by nothing but trust in the United States government. The very next day, the value of the dollar began to fall, and the world entered a new, untethered age of money, an age that would soon spin into chaos. That chaos arrived in October 1973. On the 6th of that month, Egypt and Syria launched a surprise attack on Israel. The war lasted about 3 weeks, and with American support, Israel prevailed. But the war had a weapon that reached far beyond the battlefield. In retaliation for Western support of Israel, the Arab oil-producing nations of OPEC did something the world had never seen. They turned oil into a weapon, cutting supply and letting the price explode. In a matter of months, the price of a barrel of oil roughly quadrupled, leaping from around $3 to nearly $12. The effect was devastating, because almost everything, every product, every delivery, every factory, depends on the cost of energy. The price of everything began to rise. The great gas-guzzling American cars, drinking fuel, suddenly couldn't be sold. Buyers fled to smaller, efficient imports. And a disease crept into the Western economy that it hadn't seen in generations: relentless, grinding inflation. By the late 1970s, under President Jimmy Carter, it had spiraled into the double digits. Prices climbed into the teens, savings quietly eroded, and the country felt as though it was losing control. Carter's presidency was battered, most famously by the Iran hostage crisis, where 52 Americans were held captive for well over a year, and a rescue mission ended in humiliating failure. It was a decade that felt, to many Americans, like a slow national unraveling. Somebody was going to have to do something brutal to stop it. That somebody was a towering, cigar-smoking central banker named Paul Volcker, who took charge of the Federal Reserve in 1979 with a single, uncompromising mission: kill inflation, whatever the cost. And his medicine was savage. To choke inflation out of the economy, Volcker raised interest rates to almost 20%, a level that seems almost unimaginable today. Borrowing money became punishingly expensive. Businesses stalled. Unemployment soared. The country was thrown into a severe recession in the early 1980s. It was agonizing, but it worked. Slowly, painfully, the fever broke. Inflation, which had raged in the teens, was dragged down toward 4%. Volcker had done the impossible. He had tamed the beast, though the whole nation had to suffer to let him do it. And once inflation was defeated, and Volcker could finally begin lowering interest rates again, the ground was set for one of the greatest booms in market history. The 1980s roared to life. A new president, Ronald Reagan, cut taxes, championed deregulation, and poured enormous sums into the military, an arms race designed to spend the Soviet Union into collapse, including the futuristic missile defense dream nicknamed Star Wars. It created towering government deficits, but it also created a mood of soaring, almost intoxicating confidence. And as interest rates fell and inflation stayed dead, money came pouring back into the stock market. What followed was spectacular. From its low in 1982, the market tripled in 5 years, the Dow marching up toward 2,700. Wall Street became the glittering center of the culture. A world of fortunes made overnight, of greed is good, of young traders in expensive suits who believed the market was a machine that only ever went up. By the summer of 1987, the confidence was total. And in that confidence, almost no one was paying attention to a quiet, invisible danger that had been wired directly into the market itself. Because during this boom, something new had crept onto Wall Street: computers. For the first time, powerful computer programs were being used to trade stocks automatically, buying and selling in an instant without a human pulling the trigger each time. This was called program trading. On its own, it just made things faster. But paired with it was a second, far more dangerous idea: a strategy called portfolio insurance. Let me explain it simply, because it is the heart of what went wrong. Portfolio insurance was sold to big investors as a way to protect themselves from losses. The way it worked was this: a computer program would watch the market, and if prices started to fall, the program would automatically sell stocks to limit the damage, and if prices fell further, it would sell even more. The idea was that you'd never ride a crash all the way down. The machine would get you out. On paper, for one investor, it sounded clever. But now, look at what happens when everyone is using it at once. If the market drops a little, thousands of these programs, all across Wall Street, automatically start selling. That selling pushes prices down further, which triggers the programs to sell even more, which pushes prices down again, which triggers still more selling. Do you see it? It's a machine designed to sell more the market falls. A self-feeding loop, an accelerator with no brakes, buried invisibly inside the market. Everyone thought they'd bought insurance. What they'd actually done, collectively, was build a doomsday device and wire it to a hair trigger. All it needed was a spark. By October 1987, the sparks were everywhere. Interest rates were creeping back up. A brand new Federal Reserve chairman, a man named Alan Greenspan, just 2 months into the job, had begun tightening. The dollar was weak, America's trade deficit was alarming, and the market, after tripling in 5 years, was stretched dangerously thin. It was a tower built too tall, waiting for a breeze. In the week before Black Monday, the market began to slide, unnerving traders around the world. Anxiety rippled from one time zone to the next. The tension was becoming unbearable. And then came Monday, October 19, 1987. The panic didn't start in New York. It started in Asia and rolled west like a wave, market after market falling as the sun crossed the globe. Hong Kong, then Europe, and then New York opened. It opened down hard, and the moment it did, the machines woke up. Prices fell, so the portfolio insurance programs began automatically selling. That selling drove prices lower, which triggered more programs to sell, which drove prices lower still. Exactly the death spiral the system had been quietly designed to create. Except now it was real, and it was happening at the speed of a computer, far faster than any human panic in 1929. Wave after wave of automated selling crashed into a market with no buyers left to catch it. Traders on the floor watched in disbelief and horror as the numbers simply fell and fell and fell all day long. By the closing bell, the Dow Jones had dropped 508 points, 22.5% of its entire value, gone, in a single day. It was, and remains, the worst day in the history of the American stock market. And overnight, the carnage spread to every market on Earth. There's a story about the new Fed chairman that captures the sheer disbelief of that day. Alan Greenspan was traveling, flying to a speech, and as he landed, he was told the market was down 508. The story goes that for a moment, he felt relief, thinking the market was down 5.08 points, a minor dip. Then the horror set in as he realized what he'd actually been told: 508. Now the entire world held its breath for Tuesday. Would the financial system even survive? Would the banks open? Was this the beginning of a second Great Depression? And here, Greenspan, barely 2 months into the most powerful economic job on Earth, made a decision that would define his entire era, and that stands in stark contrast to 1929. Where the authorities in 1929 had stood back and let the system burn, Greenspan did the opposite. Before markets opened Tuesday, the Federal Reserve issued a single, short, forceful statement, promising to serve as a source of support and to flood the banking system with all the money it needed. It was a promise to catch the falling market. And it worked. The panic was contained. The system held. But that moment planted a seed that would grow for decades. Wall Street learned a powerful, dangerous lesson that day. When things get bad enough, the Fed will rescue us. That belief, that there is always a safety net beneath the casino, would come to be known as the Greenspan put. And it is a direct ancestor of the great bailouts of 2008. Now here is the twist that makes Black Monday so strange and so instructive. After the worst single-day crash in history, almost nothing happened. There was no Great Depression, no decade of breadlines. The economy barely stumbled, and the market itself recovered its losses within about 2 years, and then marched on to new record highs. Compare that to the others. After 1929, the American market took about 25 years to recover. Japan's market, after its own bubble, took more than 30. The dot-com crash took 15. But 1987, the biggest one-day drop of them all, was healed in roughly 2. Why the enormous difference? In a word, intervention. In 1929, the system was left to collapse on its own, and the wreckage lasted a decade. In 1987, the central bank stepped in instantly and caught it. And that is the great, unresolved question that haunts all of modern finance. The rescue in 1987 clearly prevented terrible suffering, but it also taught the market that it would always be saved. And a market that believes it can never truly lose is a market that will eventually take insane risks. The medicine that cured 1987 is the same medicine that, arguably, made 2008 possible. Saving the patient and creating the addiction turned out to be the very same act. Black Monday changed markets forever. In its aftermath, regulators invented circuit breakers, automatic switches that halt all trading when a market falls too far, too fast, giving panicked humans and runaway machines a moment to stop and breathe. They still exist today, and they've been triggered in crises since. It was an admission of the new reality, that markets had become fast machines that sometimes need to be forcibly switched off. And Black Monday was only the beginning of the machine age of finance. The automated trading of 1987 was primitive compared to what came after. The high-frequency trading and lightning-fast algorithms that dominate markets now, and the flash crashes they occasionally cause. The ghost of Black Monday lives in every one of them. Even the legends were humbled that day. The famous investor George Soros, already a serious player running his quantum fund, was caught badly by the crash and took heavy losses. But here is the lesson in that story. He survived. He kept enough to stay in the game. And 5 years later, in 1992, that same George Soros would make around $1 billion in a single audacious bet against the British pound, a trade so legendary it made him a household name across the world. The crash bruised him. It did not finish him, and that made all the difference. So what does Black Monday leave us with? A handful of hard-won lessons. First, think of the market like a long game of poker. The single most important rule is not to win big on any one hand. It's to never go all in and lose everything, because the moment you're out of chips, you're out of the game forever. You can't win back what you no longer have the ability to bet. Survival first. Always keep enough to play the next hand. Second, nothing rises forever and nothing falls forever. The steepest booms are the ones most likely to end in a sudden, violent crash. And sometimes that crash is a black swan, an event so fast, so unexpected, that no one saw it coming. Black Monday came out of a clear blue sky. The next one usually does too. And third, the hardest one. In the depths of a crash, when everyone is terrified and selling, that is precisely the moment fortunes are made by those with the courage and the cash to buy. As Warren Buffett puts it, be fearful when others are greedy, and greedy when others are fearful. There's an even older version of the same wisdom, attributed to the banker Baron Rothschild, that the time to buy is when there's blood in the streets. It is easy to say and almost impossible to do, but it is the difference between those who are destroyed by a crash and those who are made by it. Black Monday was the day the machines took over. A warning flashed across every screen on Earth that we had built a market faster than our own ability to control it. We caught it that time. The real question the day left behind is the one we still haven't answered. What happens the day we can't?